Today on Think Smart with TMFG, we're going to be discussing the effect of war on the marketplace. I don't know what we're going through right now, if it's going to be a war with the U.S. or where their involvement is, but we thought it would be appropriate to give some insight into what effect war times do have on the markets. What's your thoughts on all this?
Oh, wow, Mike, it's a scary time. And you can feel it. It's palpable when we have meetings. Clients, that's the first thing that they ask is, with all this uncertainty and bombs going off, Israel invading Iran, and now US getting involved. It's a very scary time. And the first question is, what's going to happen in our portfolio?
Yeah, it's conflict and it's war, and it's hard to decide when it went from conflict to war, right?
Exactly.
In hindsight, they always go back and you can date times after the fact, and they can give us all the start date, this is what started this, but we don't know when this conflict, well, we know about when it rises, but we don't know when history is going to say this has started. So we're watching it as it goes along, and we watch the U.S. get involved, which is always a big start. So most of the stuff we're going to talk about are U.S. conflicts
Right.
going forward, because that's the easiest one to relate to the situation we're in now. So let's start and go back through the different times of wars. So we're going to go way back. We're going to go back to 1915, and that was World War I. When World War I happened, the markets fell by 30%. And you know how they handled that in World War I?
No.
They closed the markets.
Right. Exactly. If you don't have any control over it, just shut it down and it can't go down any further.
So they were closed for actually 6 months.
Wow.
And then after that 6 months, they reopened the markets. And how do you think the markets did when they reopened them?
Well, I can imagine that they skyrocketed upwards.
Yeah, they were actually up by 88% when they opened them. So that was the first experience we had going through World War I. But again, the markets were thin. It was much different then because we didn't have, obviously, there were no computers, no electronic trading. This was just the effect it was having on the overall markets. Next, we move into World War II, which was 1939 to 1945. And the start of it, the markets fell by about 17%. So pretty good drop.
Yeah, no, at its lowest point, it was down 17% over that period of time. And I think everybody would agree that a 17% drop in the market or even into their portfolios would be worth being concerned about.
It would catch your attention.
Absolutely.
Yeah. And remember, this is the market. So we have everyone in a balanced portfolio. So, if you had a 17% drop, you may see, a 10% drop on a portfolio. It wouldn't be as much as that because for most people, we do have some bonds. And again, some other things that are interesting is bonds tend to do better in war times. People go for safer havens. Gold tends to do well in war times. And sometimes oil tends to do well in war times. But again, the oil thing may be related to who we go to war with.
Yeah, no, exactly. It tends to be one of the precursors to the wars.
World War II, when it ended, how much were the markets up by?
Well, if you can imagine, they were up 62%. So from that lowest point, being down 17% to finish up 62 at the end of the war, it's exactly what we talk about is, even though there is uncertainty and you're feeling nervous and you're feeling panicked, the best thing you can do is just remain invested for that eventual recovery.
Yeah, because the problem is if someone takes a knee-jerk reaction, they see that drop and they panic and they pull out of the market, they miss all that recovery. And it's going to happen during a war. That happened during World War II. Imagine, that's the big war of all times. The market still recovered over that time period. It's obviously, it depends on where you are. The U.S. has been, we're talking about the side of the people that win the wars, right? So
Right, exactly.
I'm sure if you talk to Germany, they'd have a whole different view of what World War II looked like.
Right.
It was devastating for their economy for forever, but on the victorious side of the war, it's not as bad as you think going in there. I know people have always said war is good for the economy. That's been one of the sort of things they've talked about, and that's, I guess they go back and look at this historical data, and a lot of it they said was after the war, U.S. did rebuild a lot of the world, so create a lot of jobs and opportunity and continue to push the markets over there. Next one we're looking at is one of my favorite shows, MASH.
Yes.
And they always said the show went a lot longer than the war. The war is from 1950 to 1953, and I think the show went on for, I forget, something like 10 years. So.
Oh, you're dating yourself, Mike. The MASH was, I think I was born or a couple of years old when MASH was big.
Back then, during that Korean War, the markets fell by about 5% at the start of the war. Later on, they finished up by about 30%. There was something that was introduced at that time called the GI Bill in the U.S., which was helped to train the returning veterans from the war, which tended to work very well for the U.S. economy. So it was a very good, they realized that when people come back after war before, it was a terrible situation, they were untrained. So when you take people from 18 to 20, 23, 24 years old because of the draft that they had set up,
Right.
when they come back, you end up with 24-year-olds that are not trained to do anything other than war
Right.
stuff, right?
Right.
So that's not very helpful to your economy. So they brought in this GI Bill, and they pay for education and things like that. The next one was the Vietnam War, and that was 1961 to 1973. When I looked this up, I didn't realize it went back as 1961. Seems like a long time for it to go back. We always think of Vietnam War during
Right.
Woodstock and
Yeah,
things like that.
exactly.
So I always think of 69 being the time when it was going on, but it appeared to have been going on for a long period of time. It's funny, when they went in 1961, the markets gained 1.3%, or sorry, it was actually, I think it was 13% in 1961 and 6.9% in 1962. So the markets were actually relatively strong during those first couple of years of the Vietnam War. Talk about some more recent ones, Carlo. We're getting
Yeah.
more to your age bracket.
Yeah, no. So this is a little bit more relevant for me. There's the war that happened over a couple of decades, actually, in Afghanistan, starting 2001 and 2021, over a 20-year period. In that first year that the war started, the S&P 500, and I should just remind everybody that this is what we're talking about, the S&P 500 as an index, and that's the index that just tracks the U.S. market. And because we're talking about wars that involve the U.S., we thought it'd be important to discuss the S&P 500. But in the first year, the S&P 500 dropped 25%, which, again, I just talked about it. When you see that dramatic of a drop in your portfolio, it's going to make everybody concerned, ready to make that knee-jerk reaction that you just talked about not doing.
That was a unique drop. But it's funny, when we talk about that time period, what do we call that? We call that the dot-com. I've never heard anyone
Exactly.
say that was the Afghani crisis
Right,
back in
exactly.
2001. We know the effects were, number one, the dot-com.
Mm-hmm.
We had 9/11 happen, which
Mm-hmm.
is obviously related to that. And that's what really caused that pullback in the market. So again, wars happen throughout these times, but it seems what's more relevant is what's going on the actual stock markets. And we had overpriced securities
Mm-hmm.
in the tech sector. And again, you can say it was during the war, but that can just be coincidental too.
Well, yeah, no, it's interesting you say that because, we talk about the performance of the market over the long term, and we know that the market at some point is going to drop temporarily. And whether you attribute it to the start of the Afghanistan war or 9/11 or the dot-com bubble bursting, the market dropped at that time. So we just have to understand that it's going to drop anyways. There's always going to be an event that occurs that coincides with that drop.
Crude oil tended to go up during that. We saw a
Yeah.
31% increase. But again, with the oil, the war was going on in that part of the world. So when we
Right.
look in all these oil producing nations, when you're having conflict over there, it's going to drive up oil prices.
Right.
I guess now we have the next one was the Iraq War.
Yes.
And that was 2003 to 2011. S&P 500 actually rose by 26.7% over that time. Oil also went up by another 24% that time. So again, that was a positive situation.
Mm-hmm.
It was funny when I was looking at how many conflicts and wars we've had since 1929. There was something like 31 different. That's not the U.S., but
Right.
world conflicts going on. So
Yeah,
they're
just
always,
in general, more than 30 some odd conflicts or wars going on. And yet we know what the S&P 500 has done since then, average between 9 and 10%.
and I guess when we look in general, if you look at the last 5 major wars, 60% of the times the market rose during the first year of the conflict.
Right.
Right, and that's very surprising when you go and look at it. But you assume that as soon as you go into it, you're going to find a fall in the market,
Right.
and absolutely, it can happen.
Yep.
And it has happened when we go back to World War II, and we go back to some other things. That is always a possibility in there. We know that gold has been a safe haven, but again, I look at these. They show me all the figures on it, but gold used to be a fixed price.
Right.
Right. So they go back to these world wars and they say, yeah, gold held up fine. Yeah, but gold had a fixed price to it
Right.
at that time. So, but gold still seems to be a relatively safe haven that people go to. And oil has done well, but that more be related to these wars being in the regions that are producing oil. So
Right.
I guess the main thing to tell to people is as you go, hopefully this doesn't come out to be a war, and hopefully this isn't going to the history books as a big conflict and it comes to an end rather soon.
Right.
But along the way is not to panic and not to make any knee-jerk reactions to this stuff.
Yeah, I think that's what we have to take away from this is, again, we've had a couple of years where the markets have been very good. We're bound to see a drop, and it just so happens that the tariff talk has caused there to be volatility in the market. And now with Israel invading Iran and now U.S. getting involved, we're seeing the market pull back and potentially come back. But again, you need to stay strong and have faith in the market and remain invested. Because again, if we just think about what we're investing in companies, and we're incredibly diversified. And whether these companies are impacted by the war directly, they'll just continue still to be, providing services that people will consume and creating products that people will consume.
As long as you go out, there's still people in restaurants, there's still cars on the street driving,
Exactly.
there's still people in your supermarkets buying stores. The markets will continue to do well.
All right.
Well, that brings us to another episode of Think Smart with TMFG. Thank you very much. And if anyone has any questions or concerns about anything, please feel free to give us a call.